Hi, this is Sridhar Rangarajan. Welcome to the DigiLearning series by Reliance Smart Money. Today we will be speaking about an introduction to debt mutual funds. What are its types? What exactly does it mean? How many categories does it fall under? Who is it suited for? And finally, what are the exit routes in debt mutual funds? The standard textbook definition of a debt-oriented mutual fund is one of a mutual fund which invests in fixed income securities of both government as well as different corporates. What it actually means is that just like equity mutual funds, debt mutual funds also hold individual fixed income securities, which forms a large portfolio. And these typically possess similar characteristics in terms of credit rating profiles, interest income earned, and maturities. Similarity with equity mutual fund continues in a sense that debt mutual funds are also available in an open-ended and a closed-ended form. But unlike equity mutual funds, debt mutual funds are allowed to invest in both the listed as well as the unlisted space, which is not so for equity mutual funds. Friends, whatever the definition might be, the predominant thought behind any investor's interest in a debt mutual fund is that of earning a fixed income over a period of fixed tenure with a reasonable amount of capital protection. However, in the current scenario, considerations of principal protection and more importantly, the continuity of interest payment schedule is very important for an investor to consider while entering or staying invested in a debt mutual fund. Let us now look at the different categories of debt mutual funds. You would be surprised to know that a total of 16 categories under the open-ended debt mutual funds exist. For the sake of simplicity, let us segregate all these categories into two bunches. The first bunch shall represent all debt mutual funds which hold papers which have less than 1 year maturity. There are 6 categories which fall under the first bunch: overnight fund, liquid fund, ultra short term, low duration, floater, money market. The second bunch are those debt mutual funds which hold papers whose maturity profiles are greater than 1 year. Under this bunch, there will be short duration, medium to long duration, and gilt. Finally, the categories which are not bunched in the above two are as follows: dynamic bond fund, which invests in papers across different maturity profiles; corporate bond fund, which invests about 80% or more in corporate papers which are rated AAA and above; banking and PSU fund, which predominantly invests in papers which are issued by either banking or PSU peers; and finally, credit risk fund. Credit risk fund is today extremely notorious because of a lot of default which has happened in the category and a principle of investors at risk. By nature of its existence, it invests in corporate papers which have lower credit quality. For all fixed income instruments, the credit quality of the bunch of papers that it holds represents a measure of riskiness as well as safety of that portfolio. For instance, a portfolio which holds high credit quality papers shall yield lower in comparison with a portfolio which holds a lower quality paper. The return which a debt mutual fund generates comes at a price, and herein where an investor needs to walk the tightrope between credit quality and return expectation. Few important decisions that an investor needs to make during entry or choice of a debt mutual fund are: firstly, choice of whether to enter an open-ended debt mutual fund or a closed-ended debt mutual fund like an FMP, which is a fixed maturity plan. A fixed maturity plan is to be noted as a hold to maturity portfolio, and it typically is for 3 years so that it enjoys the taxation benefit. Second and more critical choice that an investor has to make is the one between credit risk and return expectation. As we saw earlier, with higher credit risk comes greater return profile. In today's time, it might not be prudent for an investor to accept higher credit risk for greater income expectation. Most investors fall prey to this decision-making paradox. Investor has to realize that the biggest risk that investment in a fixed income instrument or a debt mutual fund is default risk. A risk when the capital in itself is not paid out. Hence, in today's macroeconomic environment, it might not be worthwhile to chase higher returns while compromising on credit quality. Let us now look at the exit routes available for debt mutual funds. Firstly, for a closed-ended debt mutual fund, it is a clear hold to maturity portfolio and it has to be held till the time of maturity. Open-ended debt mutual funds have better exits, albeit a small exit loads in certain categories might be applicable as a penalty provision. For instance, liquid, overnight, ultra short term, low duration categories might have exit load periods starting from 0 days to 60 days. Similarly, short, medium, and long duration debt mutual funds might have exit load periods ranging from 60 days to 1.5 years. This, my friend, is an introduction to debt mutual funds. There are many pointers that we have to note, like yield, Macaulay duration, what is the maturity profile, what is coupon of debt mutual funds to take into consideration. All of this we will address in future videos. Stay tuned.